Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 175, recorded here on July 27th, 2025. This podcast is for entertainment only and is not investing advice, so please do your own homework. Took a break last week, a little family get together, so skipped an episode, but we are back. And there's lots to talk about, as usual. We're at block 907444, Moscow time 839. Fees are 3, 3, and 4. We'll begin with the market update outlook. So probably call it the fiat market update outlook. And I don't know how much longer I'm going to do this. I'd like some feedback. Um, Listening to Jeff Booth on a podcast this week talking about putting your energy into the system that you want to be in and taking your energy away from the system that steals from you. So maybe we don't care, although I do sometimes find it entertaining to read what's happening with stock market. Anyway, we're going to keep doing that for the time being. Market update outlook, fiat market update outlook, we shall call it. Then we'll get into the weekly top Bitcoin news. Check out this week's featured post on the Bitcoin Fortress Substack. Do a quick look ahead. Lots of cool, interesting articles coming up there. Talk about the book, and then we're going to wrap it up. So let's jump in to the news, the fiat news. Wall Street on Friday wrapped up a strong week, with the benchmark S&P 500 index notching its 14th record close of the year at 6,388.64 points. Sentiment was boosted by positive trade developments and solid quarterly reports from some of the world's largest companies. U.S. President Donald Trump announced a massive deal with Japan on Tuesday, one he touted as perhaps the largest ever made. As per the agreement, Japan has agreed to invest $550 billion in the US, while goods imported from Japan will be subject to a 15% tariff rate. Trump also hinted at further progress on trade with China, saying he might visit the Asian nation in the not too distant future to meet President Xi Jinping. Finally, Trump said he sees a 50-50 chance, or perhaps less, of the US and the European Union reaching a trade agreement. Also of note, the uneasy nature of the relationship between Trump and the Federal Reserve took another turn this week after the president became the first incumbent U.S. leader to visit the central bank since 2006. Trump and Fed Chair Jerome Powell visibly clashed over the alleged costs of renovating the Fed headquarters, with the president again pressing Powell to cut interest rates. The second quarter earnings season picked up steam this week, with electric vehicle maker Tesla and Google parent Alphabet leading the charge. Tesla shares slid after the firm reported its worst quarterly revenue decline since 2012, and CEO Elon Musk warned of an increasing probability of a few rough quarters ahead. Conversely, Google impressed investors by easily beating expectations and sharply increasing its spending forecast. For the week, the S&P 500 climbed 1.5%, while the tech-heavy Nasdaq Composite gained 1%. The blue chip Dow added 1.3%. And looking ahead, Wall Street will gear up for an extremely busy week ahead, with market participants set to receive a deluge of quarterly results from scores of companies, an extremely packed economic calendar, and the Federal Reserve's fifth interest rate decision of the year. Investors will also be keeping a close eye on U.S. President Donald Trump's current trip to Scotland, where he is expected to meet major leaders, including Ursula von der Leyen, the president of the European Commission. Tech titan Microsoft, Facebook parent Meta Platforms, iPhone maker Apple, and e-commerce and tech giant Amazon will headline the earnings season this week. The economic calendar will see several updates on the labor market, culminating in the non-farm payrolls report for July on Friday. Traders will also be getting The second estimate of US Q2 GDP growth, followed by the Fed's preferred inflation gauge, the Core Personal Consumption Expenditures Price Index for June. Speaking of the Fed, the central bank's Monetary Policy Committee is widely expected to hold the federal funds rate steady at the culmination of its two-day meeting on Wednesday. Powell's remarks at the post-decision press conference will be heavily scrutinized at a time when President Trump has piled on enormous criticism and pressure to cut rates. Printer go burr. All right, getting into the Bitcoin news, here we go with Hodler's Digest from Cointelegraph for July 20th to 26th. And here's the top stories. The Australian federal court ruled in favor of fintech company Finder.com, clearing it and its yield generating product Finder Earn in a legal battle with the Australian Securities and Investments Commission that lasted almost 3 years. In a Thursday court decision, Justices Stuart Cheeseman and Meager confirmed a previous judgment that Finder Wallet and Earn complied with consumer financial laws. The federal court confirmed the initial finding that Finder Earn was not a financial product, Finder said in a Thursday blog post. Bitmine gobbles over 2 billion in ETH in 16 days amid Treasury arms race. Don't care. XRP price drops 19%, but analysts say it's a healthy correction. Don't care. Shitcoin. Well, this is shitcoins, but it's probably worth mentioning anyway. Meme coins inspired by the late wrestling legend Hulk Hogan and Black Sabbath rocker Ozzy Osbourne skyrocketed as tributes flooded over the two popular icons' deaths this week. Terry Bollea, better known by his wrestling ring name Hulk Hogan, was reportedly pronounced dead in a hospital on Thursday at the age of 71 after medics arrived at his home to answer a call about a possible cardiac arrest. This comes just days after Ozzy Osbourne, the hard-partying frontman of English rock band Black Sabbath, passed away on Tuesday at the age of 76. Rest in peace, both of you. Hogan was the most famous wrestler in the WWF, now WWE, during the 1980s. I grew up watching him. I will admit that. And had a career that spanned decades, both in the ring and across television and film. And again, rest in peace, Hulk. Osborne, often nicknamed the Prince of Darkness, is considered a legend in the music world and is seen as an iconic heavy metal musician. Black Sabbath is estimated to have sold 75 million albums globally. Ether will knock on $4,000 and soon outperform Bitcoin, according to Mike Novogratz. Don't care. Here's some quotes. This one from Robert Kiyosaki, author of Rich Dad Poor Dad. Pigs get fat, hogs get slaughtered. I am buying more Bitcoin and getting fatter. Uh, Mike Novogratz. Yeah, we don't care. We don't care about Ethereum. And let's see. Top prediction of the week. Again, Ether. Don't care. Eric Trump over 8,000. Global M2 money source. Yeah, fine. Buy ETH if you want, but I'm not going to be doing that. An Arizona woman was sentenced to more than 8 years in federal prison for helping North Korean operatives infiltrate U.S. cryptocurrency and tech firms using stolen identities and fraudulent documents. According to a Thursday announcement by the U.S. Attorney's Office for the District of Columbia, Christina Marie Chapman was convicted of wire fraud conspiracy, aggravated identity theft, and money laundering conspiracy. She was sentenced to 102 months, or about 8.5 years, in prison. Prosecutors said Chapman worked with operatives tied to the Democratic People's Republic of Korea to obtain remote IT positions at more than 300 U.S.-based companies. The North Korean workers posed as U.S. citizens and residents in a scheme generated over 17 million in illicit revenue. More than half a billion in long positions were liquidated across the crypto market on Friday as the price of Bitcoin slipped below 116,000 amid a broader market tumble. According to CoinGlass data, 585.86 million in long positions were liquidated, with Bitcoin accounting for 140 million of that total as it dropped 2.63% to 115,356. Ether followed with 104.76 million in long liquidations, falling 1.33% to 3,598 over the same period. Two men accused of kidnapping and torturing an Italian man in a Manhattan townhouse as part of a cryptocurrency extortion plot have been granted bail. John Wolitz, 37, and William Duplessis, 33, were each issued a $1 million bail on Wednesday by New York Supreme Criminal Court Judge Gregory Caro, according to a report from ABC News. Both men have reportedly pleaded not guilty to charges including kidnapping, assault, and coercion. Case stems from a crypto extortion incident that took place a few months earlier. On May 6th, a 28-year-old cryptocurrency trader visiting from Italy was allegedly abducted after arriving in New York. According to prosecutors, the man was held hostage for weeks and subjected to repeated torture as his captors attempted to force him to reveal his Bitcoin credentials. OPSEC, folks, don't let anybody know you have Bitcoin. Don't even wear as much as you want to. Don't wear the Bitcoin shirt, the Bitcoin hat in public. Just be low key. You don't want to suffer a $5 wrench attack, even if they can't get your keys. You just don't want to deal with it. Low profile. Uh, what else is here? Oh, this is interesting. Bitcoin miner scores a $373,000 block reward. A solo Bitcoin miner successfully, wasn't me, by the way, uh, successfully mined a block on Saturday, collecting the 3.125 BTC block reward valued at $372,773. The miner operating through the Solo CK pool, a solo mining service, successfully mined block 907283, which contained 4,038 transactions and block fees totaling $3,436. Rising network hash rate and difficulty make it increasingly harder for solo miners to compete with large-scale corporate mining firms. Despite the odds against solo miners, one successfully mined a block in February 2025, followed by a miner who used just 2.3 petahashes to solve the puzzle and collect the $350,000 block subsidy earlier in July. The improbable and nearly impossible victories of solo miners are a reminder that even smaller players can still successfully add blocks to the Bitcoin blockchain at a time when mining is dominated by large publicly traded companies. Even established corporations are feeling the squeeze of rising network difficulty and hash rate coupled with a reduced block subsidy. Several large mining operations have diversified into AI data centers and high performance computing to make up for shortfalls in the mining business and rising competition. The current Bitcoin network difficulty is about 126 trillion and is floating near all-time highs. Bitcoin's network difficulty is also trending up over time. This forces miners to expend ever greater computing and power resources to mine a single block, which yields a 3.125 Bitcoin reward valued at about $373,000 at current prices. The competitive industry runs on thin margins, incentivizing companies to find the cheapest energy resources to maintain the maximum uptime, which is affected by weather events, overall climate, and power continuity. In June, several Bitcoin miners in Texas were forced to curb their energy consumption to avoid paying peak demand charges to the grid operator, causing a fall in short-term block production. Mara was among the mining firms that reported lower output numbers for June due to weather conditions slowing down mining operations. And that about wraps it up for the Hodler's Digest. Some additional Bitcoin highlights from the week just ending, July 27th. First, Galaxy Whale exits spark debate over Bitcoin's ideological future. Galaxy Digital facilitated a $9 billion sale of 80,000 Bitcoin from a Satoshi era holder. Crypto commentator Scott Melker argued this signals early adopters even losing faith, sparking debate about Bitcoin's transition from cypherpunk roots to institutional asset. Others counter that institutional tools are needed for Bitcoin's broader adoption, framing it as an evolution rather than an ideological betrayal. And that's probably what drove the price down, but then the price recovered quite nicely, which means there's plenty of people willing to take those coins. And I hope they like whatever they got for those, because uh, it's probably not going to continue to appreciate as much as Bitcoin is. But oh well, to each their own. If they don't sell, then there isn't coins to buy, right? So Robert Kiyosaki warns of imminent crypto and gold crash. He's been talking about this for a while. In a widely shared post, Rich Dad Poor Dad author Robert Kiyosaki cautioned investors of bubble risk in gold, silver, and Bitcoin, even as he indicated readiness to buy on dips. Yes, there's a bubble in everything. Trump Media invests $2 billion in Bitcoin for treasury diversification. On July 21st, Trump Media and Technology Group disclosed a $2 billion Bitcoin purchase, representing around two-thirds of its $3 billion liquid assets. The company also allocated $300 million to Bitcoin-linked options, signaling strategic use of crypto assets to support its platform ecosystem. Citigroup sees Bitcoin value tied to adoption, not mining costs or stock to flow. Citi analysts recently updated their valuation model to emphasize user adoption and market demand, downplaying mining cost and stock to flow metrics. They cite strong ETF inflows and regulatory clarity as key drivers of price appreciation. And historic BLE and US Genius Act and broader digital asset policy shifting the landscape. The Genius Act was signed into law July 18th, establishing the first US federal framework for stablecoins, requiring dollar backing, reserve audits, and dual federal state oversight. Alongside the Genius Act, the Clarity Act and the Anti CBDC Surveillance State Act passed the House during Crypto Week, aiming to define digital asset oversight and prohibit U.S. central bank digital currencies. We've probably talked about this before on this podcast, but a private CBDC is just as bad as a public one. Analysts highlight stablecoin regulation as a potential adoption catalyst, but also raise warnings about institutional entanglement in crypto markets. And of course, the relevance of all this, market sentiment, whale activity, and Kiyosaki's commentary reflect both confidence and fear in the market. No surprise there. We're continuing to see institutional adoption, significant corporate treasuries, and legal frameworks push Bitcoin toward mainstream legitimacy. Regulatory clarity, always important for the institutions to jump in. So the US legislation is bringing that. Consumer protections and new business opportunities, especially for the banksters. And valuation shift, models linking Bitcoin value to adoption and ETF flows suggests investor behavior now outweighs traditional metrics. And of course, in all of this, ideological tensions, the debate over Bitcoin's cypherpunk identity versus financial innovation remains alive. And I guess the way I look at it is you can choose how you want to interact with Bitcoin. If you want to continue to hold your coins in self custody, if you want to use them and transact with them, either on chain or through the Lightning Network to pay for things, you could do that too. You don't have to choose a Bitcoin ETF, but if you want to, you can. If that's the easiest way for you to get exposure in your 401k or IRA, then go for it. Otherwise, you can also get IRA through many different providers and holds your coins in multi-sig self-custody. And you don't have to go that route. So I think the point is that you can continue to keep Bitcoin's cypherpunk identity alive by running your own node, by plugging in a couple BitAx miners in your house, by holding the majority, if not all, of your Bitcoin in cold storage, self custody, and keep the dream alive. Next up from Bitcoin.com news. Global liquidity surge sets stage for Bitcoin price explosion. I just love reading some of these. Plenty of crypto fans are banking on the idea that a ballooning M2 will give the digital currency space a major lift. This notion has been regularly making the rounds on platforms like Reddit and X, where users are spinning up threads and sharing posts dissecting exactly how this would unfold. Essentially, M2 represents a broad measure of money supply in an economy encompassing physical currency in circulation, demand deposits in checking accounts, savings deposits, money market funds, and other highly liquid near money assets. Unlike narrower measures like M1, which focuses on cash and checking deposits, M2 captures funds readily available for spending or investment, providing insight into economic liquidity and potential inflationary pressures. In other words, M2 offers a clear window into global liquidity. Globally, M2 aggregates these figures from major economies, converted to US dollars, with recent data showing the world's four largest central banks, the US Federal Reserve, European Central Bank, Bank of Japan, and People's Bank of China, driving the total to new highs. This measure functions as a barometer for monetary policy effectiveness. Central banks influence M2 through tools like interest rate adjustments, open market operations, and reserve requirements, which expand or contract the money available in the banking system. When M2 grows, it signals increased liquidity, enabling more lending, spending, and investment, though excessive expansion can lead to inflation as more money chases the same goods and services. Got a secret for you. There's always going to be inflation in the traditional system because it can't grow without more debt. More, never less. The current rise in global M2 stems from a resurgence in government stimulus and liquidity operations, including quantitative easing programs where central banks purchase assets to inject funds into economies, and direct fiscal supports like infrastructure spending or subsidies. These policies aimed at stabilizing growth post recessions or during slowdowns have accelerated since 2020, with central banks worldwide adding trillions to balance sheets to counter economic disruptions. China's monetary expansion plays an outsized role, with its M2 exceeding $44 trillion, more than double the US figure of about 22 trillion, fueled by efforts to bolster domestic growth, support exports, and maintain financial stability amid global trade tensions. This aggressive growth, averaging over 8% annually in recent years, contributes significantly to the global increase as China's policies ripple through international markets via trade and investment channels. Historical data reveals a strong correlation between M2 expansions and rising asset prices, including stocks, real estate, and cryptocurrencies like Bitcoin, as excess liquidity seeks higher returns in riskier investments. For Bitcoin specifically, analyses show correlations averaging 0.65 to 0.89 with global M2 growth, often with M2 leading price movements by 12 to 90 days, as increased money supply erodes fiat purchasing power and drives demand for scarce assets like Bitcoin, viewed as a hedge against inflation. Social media posts linking M2 growth to Bitcoin's rise have been popping up all over X. Global liquidity is surging, one X user remarked on Saturday. M2 supply exploding. Bitcoin's chart is copying it step by step. Ignore the noise, follow the liquidity, because when liquidity floods in, BTC doesn't wait. Liquidity leads, price obeys, the X account added. In 2020 to 2021, for instance, global M2 surged over 25% amid pandemic stimulus, coinciding with Bitcoin's rally from under $10,000 to nearly $69,000, illustrating how liquidity boosts speculative flows into fixed supply assets. With M2 sitting at record levels, some crypto believers are calling for BTC to tap $150,000 on the next flush of liquidity. With global M2 now at an all-time high and projected to grow 8% to 10% annually through 2025, amid ongoing easing, Bitcoin could very well see amplified upside as liquidity historically multiplies its price sensitivity, potentially adding thousands per trillion in new M2. Meanwhile, the Trump administration is pushing hard for Fed rate cuts, hoping a dose of easing will jolt the economy. To many Bitcoin proponents, this dynamic persists despite short-term volatility, as Bitcoin's capped supply of 21 million coins contrasts with expanding fiat, positioning it to capture a growing share of global liquidity in 2025. Yes, here comes the fiat. A little more on price action. Cointelegraph posted this article. When was this? Oh, it was updated today. Bitcoin nears 120,000 as analysis predicts larger price swings next. So I guess this is saying volatility is going up. Data from Cointelegraph Markets Pro and TradingView showed BTC USD approaching a key reclaim area, now attempting a daily close above its 10-day simple moving average. The pair held on to a rebound from near 114,500 as the market forgot one of the largest ever BTC sales. The uptick came amid news that the US and China had agreed to further delay the introduction of reciprocal trade tariffs. Market participants thus focused on the key levels to look for going into the new week. BTC needs to break above 119.5 for a big move. If that doesn't happen, this consolidation will continue, crypto investor and entrepreneur Ted Pillows summarized in a post on X with a pretty little chart. Popular trader and analyst Rect Capital eyed a slightly higher range ceiling just below the $120,000 mark. Bitcoin has daily closed above the blue range low, kickstarting a break back into the very briefly lost range, he told X followers alongside a print of the daily BTUSD chart. Any dips into the range confluent with the new higher low would be a retest attempt to confirm the claim. And he also published a pretty little chart. Others warn that price could still fill the daily downside wick left by the trip to 114.5. In an X thread on the topic, fellow trader Crypt Nuevo identified a downside target confluent with an area of exchange order book liquidity. If we zoom out, we can see that the main liquidation level is at 113.8, he commented. Consequently, I consider the downside liquidation cluster to be the natural target in the midterm, 114.5 to 113.6. The latest data from the monitoring resource CoinGlass, meanwhile, puts the max pain for BTC shorts at around 119,650. Should Bitcoin return to challenge all-time highs near 123, short liquidations would total over $1.1 billion. Shorts get wrecked, longs get wrecked, but if you just hold Bitcoin in cold storage and forget about it, you sleep like a baby. Strong resistance forming around 119 to 120, indicating by dense liquidation clusters, crypto analysis platform CoinAnk agreed while examining its own liquidity data. Analyst The Kingfisher additionally warned of heightened volatility on short timeframes, seeing predominantly red on the BTC GEX Plus chart. This indicates dealers are heavily short gamma, suggesting they may amplify volatility to hedge their positions, he reported on X Sunday. Expect potentially larger price swings in the near term. Monitor these shifts closely. Or you can just stay humble and stack sats. Next up from Cointelegraph, this is always, worrisome, I guess. This was posted, I think, yesterday. Bitcoin Up year is 2026, and the 4-year cycle is dead. Bitwise exec. Ah, here we go. The cycle is dead. Bitcoin's price could see significant upside in 2026, bucking the traditional 4-year market cycle, according to Bitwise Chief Investment Officer Matt Haugen. The prediction comes as other analysts are divided on whether Bitcoin will stray from its historical pattern or follow the traditional halving cycle and peak in the coming months. I bet 2026 is an up year, Haugen said in an X video on Friday. I broadly think we're in for a good few years, Haugen added. Haugen said the 4-year halving cycle is dead for several reasons, including the Bitcoin halving becoming half as important every 4 years. Good point. And the interest rate cycle being positive for crypto. Since April, US President Donald Trump has been publicly pressuring Federal Reserve Chair Jerome Powell to cut interest rates, a potentially bullish catalyst for Bitcoin as lower rates make traditional assets like bonds and short term deposits less appealing to investors. Haugen also said the chances of significant price pullbacks have decreased as the industry gains more clarity on regulations. Blow up risk is attenuated due to improving regulation and the institutionalization of the space, Haugen said. He said that given the ongoing regulatory process and the early stage of institutional adoption, Bitcoin likely has more upside in this cycle than historical trends suggest. The long term pro crypto forces will overwhelm the classic 4-year cycle forces to the extent those exist, and that 2026 will be a good year. Haugen said the most significant cyclical style risk for Bitcoin is the rise of Bitcoin treasury companies, bears watching, and is significant, Haugen said. Asset manager Van Eck recently echoed the same concern, warning that firms accumulating Bitcoin by issuing new stock or taking on debt are particularly vulnerable. Van Eck said these companies might be overextended if Bitcoin's price falls sharply. However, Haugen forecasted that Bitcoin's price rally will be steady rather than aggressive in the short term. I think it's more sustained steady boom than supercycle, he said. I could be wrong, and I'm certain there will be significant volatility, he added. It comes only days after CryptoQuant CEO Ki Young Ju said the Bitcoin 4-year cycle theory is dead. My predictions were based on it, but when whales accumulate, sell when retail joins, but that pattern no longer holds, Ju said. Last cycle, whales sold to retail. This time, old whales sell to new long-term whales. Institutional adoption is bigger than we thought, Ju added. However, not everyone says the pattern has changed. Crypto analyst Rect Capital recently warned that Bitcoin may only have a few months of price expansion left in the cycle, especially if it follows the same historical pattern from 2020. Recht explained that if the Bitcoin cycle follows the 2020 pattern, the market will likely peak in October, which is 550 days after the Bitcoin halving in April 2024. So I guess we'll see who's right, but it didn't matter for you if you are staying humble and stacking sats. Next up from Bitcoin Magazine. This was published on July 25th. Does Bitcoin have less than 100 days left in this cycle? So, again, a lot of people asking the question. Let's see what this article says. With Bitcoin's price hovering around 120,000, speculation about where we are in the current cycle is intensifying. The data, particularly when mapped against previous cycles, suggests that this bull market could top out within the next 3 months. But does this hold true, or are there reasons to believe this time truly is different? Viewing the Bitcoin growth since cycle low chart, we can see that we're currently around 975 days into the ongoing cycle. For comparison, the 2017 bull market topped out 1,068 days after its cycle began, while the 2021 cycle peaked at 1,059 days. That places us potentially under 100 days from a peak if we're following historical precedent. And there's a nice chart in the article. Again, links in the show notes for all this. A deeper look into the TradingView overlays, aligning both the 2017 and 2021 cycles with the current price action, Both earlier cycles entered their parabolic banana zone around the same time frame, resulting in explosive price increases. Averaging the timing between the two would indicate a potential peak around October 19th. If Bitcoin continues to track the previous two cycles in terms of bull market length, we'll see a price action peak around the 19th of October. One major counterpoint to this historical view is the magnitude of recent Bitcoin ETF cumulative flows. Since January 2024, over 1.2 million Bitcoin have been absorbed by ETFs, with a good portion of that unlikely to return to the market anytime soon. This has dramatically altered the supply-demand balance. In addition to ETFs, Bitcoin treasury companies are sitting on over 870,000 Bitcoin, with that number growing daily. Sovereign holders are also account for over 500,000 Bitcoin, and we could still see national strategic reserves that would further tighten supply. When you add in coins held for over 10 years that may be lost, currently around 3.3 million total, so we'll round down to a very conservative 1.5 million. The potential non-circulating supply exceeds 4 million Bitcoin, or over 20% of the total circulating supply. Many argue that this cycle is unique due to ETF inflows and institutional adoption, but realistically, the sentiment is echoed in every previous cycle, yet each cycle has ultimately followed a similar trajectory. While current fundamentals are undeniably stronger, assuming a supercycle without hard data remains speculative. Until proven otherwise, history suggests that our traditional 4-year cycles should remain our base case. Let's assume for a moment that the cycle does indeed top in October. In such a sharp move even feasible? Absolutely. When Bitcoin crossed 10,000 in 2017, it doubled in just 2 weeks. Even this cycle, Bitcoin rallied close to 100% in under 100 days, leading up to its $100,000 milestone. Following the ETF approval, BTC surged 80% in just 50 days. Once momentum builds, Bitcoin's parabolic potential becomes reality fast. And when looking at the MVRV Z-score, we can see the on-chain data backs this up with similar run-ups from similar data levels toward market peaks. Zooming out further, 200-week moving average recently surpassed $50,000 for the first time ever. More importantly, Bitcoin's realized price has crossed above the 200-week moving average, a rare event that only occurred once before in November 2020. Back then, Bitcoin rallied by 212% in 90 days. If we follow even half of that trajectory, a 105% gain from current levels would place Bitcoin near $250,000, again, right around mid-October. While it's risky to base projections on a single historical instance, it's interesting that this is once again occurring at a very similar stage of the cycle. Every cycle carries whispers that this time is different, and while this cycle has plenty of reasons to believe that it could be true, ETF inflows, institutional dominance, sovereign accumulation, etc., the data still points toward a cycle top sometime in Q4 2025. Could we blow past that and enter a true super cycle? Maybe. And I'd love to be proven wrong, but we'll need evidence before assuming this narrative. For now, the historical cycle blueprint remains our most reliable guide. And then it says, for more in-depth look into this topic, check out a recent YouTube video here, and there's a link there in the article. So who knows? Is the cycle dead? Is the cycle not dead? If you are stacking, and hey, if the market, if it peaks and then collapses, you just buy more. Just buy on the dip. All right, and then finally this week, we're going to go through the Bitcoin podcast roundup. Since I did do an episode last week, we'll cover the last 2 weeks, and let's see what's new. Since there's so many podcasts, it's hard to follow them all. This 2 week period was rich with high signal conversations across the Bitcoin podcast ecosystem. Themes centered on institutional adoption, regulatory shifts, the evolution of Bitcoin culture, stablecoin risks, and innovations in custody and privacy. So here's the rundown. First up is Rabbit Hole Recap, episode 367, first Bitcoin company in the S&P 500. This episode came out on July 24th. Some of the highlights: Block, formerly Square, was officially added to the S&P 500, marking a milestone for Bitcoin-aligned companies. Shareholders of MicroStrategy voiced concerns about Michael Saylor's BTC strategy and the STRC IPO. And Marty and Matt discussed the broader implications for institutional legitimacy and the beginnings of a potential Bitcoin supercycle. So they're still quite bullish. TFTC, a Bitcoin podcast, episode 643, The Bitcoin Big Long, Wall Street's Coming. This one came out on July 23rd. Explores signs that Wall Street firms are preparing large long positions in Bitcoin. Discussion on macro tailwinds, liquidity flows, and the role of ETFs and sovereign entities. And commentary on how institutional behavior is shifting Bitcoin's market structure from cyclical to secular. What Bitcoin Did had several episodes this week. First one was Bitcoin Culture versus Wall Street with Thomas Paccia. That was on July 21st. Paccia, co-founder of PubKey, contrasts grassroots Bitcoin development culture with institutional finance norms, emphasizes the need to preserve decentralization and open source values as Bitcoin enters the mainstream, and he's critical of VC and TradFi co-opting narratives for profit while ignoring foundational Bitcoin principles. There was an interview with Jeff Booth, Bitcoin and the Moral Case for Deflation, on July 25th. Booth explains how Bitcoin allows for a moral economic reset, replacing inflation with deflationary abundance. He highlights in the Lightning Network applications in Ukraine, Africa, and Latin America, the Global South. And he argues that Bitcoin is freedom technology, not just an investment. And if you haven't listened to Jeff Booth, he's great. Um, he is putting all of his time and energy into the new system, not the old system. And I just love that. Interview with Nick Bhatia, Bitcoin's New Era, Liquidity and Macro Alignment. This one came out on July 24th. I'm about halfway through this one. Uh, Highlights from this: Bitcoin is no longer just a 4-year cyclical asset, it's a macro asset class with global liquidity integration. Bhatia points to Bitcoin's role in displacing real estate and traditional stores of value, something that a lot of other folks have talked about as well. And he draws parallels between treasury market mechanics and Bitcoin's emerging market structure. Natalie Brunell, Coin Stories, the weekly news block on July 21st. She talks about analysis of the Genius Act, which codifies regulatory standards for stablecoins and CBDC aligned rails. Rumors of U.S. Treasury planning Bitcoin 401k approval framework, and highlights the growing intersection of government policy and Bitcoin custody strategies. Gold, Goats, and Guns, Tom Luongo, episode 223, Vince Lanci and the Fragility of Stablecoins on July 25th. I still need to listen to this one. I will. I always enjoy uh, Tom and Vince. They're interesting guys. Lanci critiques stablecoins as opaque instruments vulnerable to political capture. Not going to debate that. Positions Bitcoin as the only true decentralized, censorship-resistant monetary asset, and explores how stablecoins will become digital fiat enforcers while Bitcoin stands apart as sovereign money. Citadel Dispatch with Matt Odell had a couple episodes. Episode CD 169, Ben Kaufman on Bitcoin Keeper and multi-sig custody, came out on July 21st. Best practices for multi-signature wallet setups with Bitcoin Keeper. Focus on inheritance planning, collaborative custody, and sovereign-friendly tools. Addresses friction between UX simplicity and advanced security. Then there was episode CD 168, Matt Alborg on pay-per-queue AI and transaction privacy, which came out on July 14th. Introduction of a new AI tool that improves privacy for Lightning and Bitcoin payments, tackles risks of metadata leakage, KYC creep, and how to maintain on-chain anonymity, highlights the growing role of AI in sovereign Bitcoin toolkits. And here's an overall thematic summary. Institutional legitimacy and macro integration. Block joining the S&P 500, Wall Street big long signals, and Nick Bhatia's analysis suggests Bitcoin has graduated into the institutional macro playbook. Of course, that's a double-edged sword because the institutions could be also big sellers when they don't like the market action or they want to buy a new sweater or whatever. So, it's all good on the way up, though. Deflationary values versus inflationary systems. Jeff Booth and Thomas Paccia both argue Bitcoin is a philosophical revolution, not just a tech or finance product. And I kind of totally agree. Regulatory movement, the Genius Act, and discussions of 401k access signal that Bitcoin policy battles are now mainstream, no longer niche. Custody and privacy innovation, new tools like Bitcoin Keeper, PaperQ, AI show the ecosystem maturing with a focus on security, inheritance, and anonymous payments. Then there's stablecoin versus Bitcoin divergence. Lancy and others argue stablecoins are Trojan horses for CBDCs. I think they just are CBDCs, just with a different wrapper, while Bitcoin remains the uncompromised alternative. So, between July 13th and 27th, Bitcoin media reflected a rapidly maturing ecosystem entering an institutional era, yet grappling with how to preserve its original values. Lightning use cases, cultural pushback, privacy, innovation, and macro alignment were all front and center. While Wall Street leans in, Bitcoin's defenders are raising the bar to ensure sovereignty and decentralization don't get lost in translation. Of course, Jeff Booth always says, as long as Bitcoin remains decentralized and secure, we are good to go. All right. Let's take a look at this week's featured post on the Bitcoin Fortress Substack. Article is entitled The Convergence of Bitcoin and AI Unleashing Human Flourishing. So please check that out. And lots of interesting stuff coming up in the Substack. Next up, Living with Gratitude, Bitcoin and Old Friends. And then we have a three-part series. Part one, Genesis and the Ghost in the Code. Part two, The Block Size War and Bitcoin's Civil War. And part three, El Salvador Energy and the Bitcoin Nation State. So kind of like a little look back in Bitcoin history. Then we have the Genius Act, stablecoins for the Treasury, not the people. A little deeper dive into the privatized CBDC. The first law of thermodynamics, Buckminster Fuller, and the birth of energy money, Bitcoin. After that, and then finally, Bitcoin Vortex. So check it out. Link in the show notes. Did want to mention my book. It's now available on Audible, and there's also a link in the show notes to it. So far, the feedback I've gotten from friends and family that have read it is it answers a lot of their questions and it's pretty simple. So it's probably a useful orange pilling book, not too much to read, but packs a lot in there. So check it out. And with that, I will thank you for listening to the podcast. If you enjoyed the show, please like and leave a comment. Don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can follow my Substack at bitcoinfortress.substack.com, and you can follow me on Nostr only, please. And my MPub is in the show notes. And with that, I will talk to y'all next week. Bye bye.